All right. So let's start our lesson today, Management Accounting Costing for Level 3. In this level, all you have to learn how to calculate the cost. Now, before we start, let's talk about management accounting a little bit because the management accounting or the paper is called management accounting. We have to know a little bit about management accounting because when we talk about the accounting is a big area. It's like a big sea. So in the big sea, there is a different type of sector or segment we have that we have to learn separately. So on the accounting C, we have a one area that is called management. And this management is the part of accounting. And inside of the management accounting, there is a lot of papers, there's a lot of things, there's a lot of modules. So one of the small modules is management accounting costing. That one we're going to do for this level. Now, let's talk about what is management accounting and why we are saying it is a management accounting. The first difference between the management accounting and the financial accounting. So we have a two types of accounting. One is management accounting and one is financial accounting. The difference between these two is the management accounting only used for the internal purpose. So if I'm the management, I have to look after the company. So I do for the company, not to report anyone. So let's say I am the management accountant for a company. Now, what will be my main job? My main job will be to look after the company. So when I say look after, what does that mean? Does that mean I have to invest some money in the business? No, I have to do some work for the business. Now the question is what type of work I would do as a management accountant. So the main job for the management accountant is to focus on the progress, the focus on the purchase performance of the business. So as a management accountant, I have to see this company is growing every day. So what was the result for the last year and what is the result for this year? So from that point of view, we can say the main job for the management accountant is to compare compare the result from the last year to this year. Now, when I said you have to compare some data, then the first thing will come to my head, what should I consider? What should I compare? Because there is a lot of thing inside of the organization. So what should I compare? Should I compare the financial factor or should I compare the management sector? So the answer will be the should I compare the financial matter or should I compare the non-financial matter? The answer will be both. So we have to make the comparison between the financial factor and the non-financial factor. Now, what is financial factor and what is non-financial factor, we will see later on. But all I can say very simply, so as a management accountant, I have to make the budget. This is the first thing I have to do. So as a management accountant, I do the plan. Now, what is plan? Plan is something that you make yourself ready for future. So you take a advanced decision what you're going to do in future. So that is called plan. Now, as a management accountant, his responsibility is to make the plan. And to make a plan, the management accountant, he prepared the budget. Now, when you prepare the budget, you have to know certain criteria inside of the budget. For example, if we said we want to go for a holiday, now if we want to make a plan for the holiday, so we have to book the hotel, we have to book the transport, we have to book maybe the place we're going to stay. So this type of thing we have to consider. So as an organization, when you want to prepare a budget, you have to consider some matters. And all this budget will be relevant to the cost. All this budget will be relevant to the profit of the company. Because as a management accountant, we have to tell to our director, we have to report to our board of directors, this is the best way we can do to maximize the company profit. So, to get a greater return, this is the policy we can follow. So, as a management accountant, our responsibility will be to report to the directors. So, let's say this is organization, and in this organization, so in one organization, the ultimate reporting board will be the board of directors. So we will only report to the board of directors. Could be executive directors, could be non-executive directors. But as a management accountant, our ultimate aim will be to report to the board of directors. Now the question is, now the question is, if I report to the board of directors, so is there anything I have to do? The answer is no. All your responsibility will be to inform the board of directors about the budget, about the changes, and what happened basically here inside of the organization. Now the question is, okay, so what we understand from here, we understand as a management accountant, my responsibility will be to inform to my board of directors about the budget, about the costing, about the organization performance. Now there is another people who want to see what's happening to our organization, how much profit we are making, how much is the asset and liability of the company, and how much is the share value. So there is a people outside of the organization and they want to see it. Who are these people? They are the part of stakeholder. They are the part of stakeholder. And who is a stakeholder? Stakeholder are the interested party to your business. Now, stakeholder could be the government. Stakeholder could be the any enforcement agency. Stakeholder could be the environmental agency. Stakeholder could be the customer. Stakeholder could be HMRC, the council, everyone. So all I need to understand, so there is two group of people. One is the management accountant who report internally. The another group is a financial accountant. Now the financial accountant, they prepare the profit and loss account and the statement of financial position, and they submit this to HMRC or the company house and telling this is the situation of our company. This is the situation of our company. So the financial accountant prepare everything for the reporting purpose to the outside of organization. As a financial accountant, we prepare everything and we report to the outside of the organization. Could be HMRC, could be company house, could be bank, could be anywhere. But as a management accountant, what we do inside of the organization, that is very, very secret. As a management accountant, what we do inside of the organization, that is very, very secret. We do not share this with anyone. We do not share this with anyone. We have to be very, very careful. The management accountant never report to the outside of the organization. So all we do is very secret. For example, let's say Tesco, they're planning to sell a new product in the market. Now, if Tesco planning to sell a new product in the market and they're making a plan how many units they can sell, what will be the cost, and they will not disclose this information to the public. So this is a job of the management accountant. On the other hand, the financial accountant, they prepare mainly the external report. So normally, if you talk about the chartered accountant or the people who work in a practice or in a firm, they are mainly the financial accountant, and they prepare the accounts and submit to HMRC. But the management accountant, they are normally the employee of the company. So if we said the management accountant, we said they are mainly the employee of the company. So this is the basic difference of management accounting and the financial accountant. Uh, is preparing SOFP and SPL come under the financial accounting? That is correct. So preparing the SOFP statement of financial position and SPL statement on profit and loss account is a part of the job of financial accounting, because this is the actual result. This is not something budgeted or planned, and you submit this thing to the outside body. So this is the job of financial accountant. Yeah, that's correct. All right, so let's move on and we'll see what we have in this course. So we have 15 chapter to cover from this book, and we'll learn mainly the cost behavior for the organization. Then we'll learn something about the allocation and apportionment. So allocation and apportionment. Then we'll learn absorption costing and the marginal costing. Absorption costing and the marginal costing, these two are cost calculation process or techniques. We have one more way that is called ABC, activity based costing. So we will see these three method, how does it work and what is the difference. So when you calculate a unit cost of a product, you have some method, and all of this method are allowed to use. So we will see which method we can use and what is the difference between the other method and what is the advantage and disadvantage and how to calculate. We'll see everything from there. Then we have some process costing. So process costing is all about when the product in the process. Sometimes we called it WIP. WIP means work in progress. So for example, if I start making something and if it is not done yet, so it is on the process, we called it WIP. The next point we have here, that is budgeting. So we're going to see how to prepare the budget. It's very, very important. If you join as a management accountant to any organization, they might ask you, do you know how to prepare the cash budget? Do you know how to prepare the fixed budget? Do you know how to prepare the flex budget? Do you know how to prepare the increment budget? Do you know how to prepare the zero-based budget? There is a lot of budget category. We're not going to learn everything from this chapter. We're going to learn only the fixed and the flex budget. The next point we're going to learn, the next topic or next area, that will be the variance analysis. So this is one of the area the management always do, variance analysis. Find the variance. Variance means difference. Find the variance. Variance means the difference. So what was the result in last year and what is the result in this year? So we find the difference, and this is called variance analysis. For example, let's say in 2019, the sales was 2 million, and 2020, the sales is 1 million. So 1 million sales is dropped. So the difference is 1 million, and that is called variance analysis. If the budgeted, when you make the plan, for example, this year 2020-21, our sales will be 1 million, but actual sales is 2 million. So that is better than my expectation. That is better than my plan. That is better than my budget. So if it is better than your plan, your budget, then it is a favorable variance. So if the company do good, better than the plan, that is called favorable variance. If the company get result less than the expected, if it is the cost, then that will be adverse. So there is two words for the variance. One is favorable, one is adverse. Favorable is the good for the company, adverse is the bad for the company. Then the last two chapter we have, chapter 14 and 15, that is about the short-term decision making and the long-term decision making. So this is basically, this is very simple here, but If you do in near future, if you do your chartered accountant course, let's say if you do CIMA or if you do ACC or ICW, based on these two chapters, there is a whole book. So there is a book called Financial Management, and you will learn everything about from the whole course, only this two chapter. So here basically we learn, let's say we have a limited amount of investment. Let's say you have a 1 million pound and you have a lot of option to invest. For example, you can invest to buy some share from Amazon. You can invest uh, to buy some government bonds. You can keep this money on the bank as FDR, you get some interest. There's a lot of option. So which option will be more suitable for you? And let's say inside of the organization, there is a three product, A, B, and C, and you don't know which one I should make. So either you can make A or B or C. So which one you should go for, where you should invest, what is the return policy. So all of this will be considered when you're using this formula. So that one will tell you invest there, not there. So use this type of technique before we make our investment, because we have a limited investment. So before we decide where should we invest, we want to see the best possible outcome. So this two chapter will help us to understand of this. All right, this is the little overview of the management accounting. Of course, we'll go every single chapter. We'll try to discuss more, and we try to do every single question, the activities we have in the book. And hopefully we'll finish this course. After that, we will do a revision class. And if we can set up the exam, if the lockdown is lifted up, so we can do the exam, we can set up the exam as well. So we'll talk about the exam later on. Let's start with our chapter number 1. So let's start with the first chapter from this book, and that will be introduction chapter. So let's have a look what we have here. The first chapter we can see that is called Introduction to Management Accounting, and we have a little bit introduction anyway. So let's have a look what we have here. How many weeks will complete? Let's see how many weeks we take. But most likely there's a 15 chapter. Let's say we'll finish by 7 or 8 weeks. We'll finish this course. Okay, so let's start with our chapter number 1. Chapter overview, management accounting. So we can see the management accounting we have. The main area is say decision making and control. So decision making is all about short-term and long-term decision making. So when we planning to invest something, so when we try to implement or introduce a new product in the market, we have to take the decision. So who will tell go for it or don't go for it? For example, let's say one company, they sell tea, and maybe they decided to sell some coffee as well. So that will be a good decision or that will not be a good decision. Who will give the report based on that? So the management accountant, they will tell go for it or don't go for it. So taking the decision and involving in the decision making process is a very, very core area for the management accountant. Then we have a costing. So we have to see how can we calculate the cost of a unit of product. So when we try to make a unit, we have to find the cost. For example, how much is the direct material, how much is the direct labor, how much is the production overhead, how much is the fixed cost. So all of this we have to calculate under this management accounting process. So management accountant are the people who calculate the cost per unit. Then we have a planning for the budgeting and the forecasting. Budgeting, we already know. The forecasting is something that you do for near future. For example, let's say you say like in this summer our sales will be like this, and you prepare the report for that. Normally the forecasting asked by the bank, for example, if you applied for a loan, the bank might ask you, can I have the sales forecast or cash flow forecast for next 6 months? So you tell them, based on the previous experience or based on the previous record, I'm expecting this year my sales will be this amount, my profit will be that amount. The control, whatever budget you make, you always have to keep a control of that. For example, let's say you decided to go for a holiday and your plan was the plane ticket will be £200. I'm going to stay there another £200, and the transport will be £100, and for the food 100. So your plan was 600. But when you went there on the holiday and you have seen there is a lot of nice stuff is there, there's a lot of nice thing is there to buy, and you start buying the clothes, maybe the shoes, and it was exceeding your plan. So, what was your budget? Whatever the budget you make before you go there, you should have a control on this budget. If you cannot control your budget, so we cannot say it is a good budget. For example, if you said, I will buy the raw material £10 per kilo, based on the market analysis, you say that. But when you buy, actually, you found it is not 10, it is 15 or 20. So we cannot say it is a realistic budget because it is really, really different than the amount you have set. So that's why the budget has to be realistic and you should have a control on your budget. All right, the next point we have here, we have some cost center, responsibility center. So let's have a look how many center we have. The center means who are responsible for that particular work. For example, the first one is the cost center. Now the cost center is only responsible for the cost. The cost center is person, place, or item of equipment that incur cost. For example, let's say Argos, they have a service center. So every time you buy something from Argos and they said, Argos will give you, let's say 1 year or 2 year maintenance services. Now within this 1 or 2 year, anything happen, Argos will repair it free for you. Now the department who repair it, they don't have an income because they don't sell it. This is a repair and maintenance department. So you take your things there and they repair it and they give it to you back and you don't pay anything. Because this is come under the sales agreement, you will get a free warranty or guarantee for 2 or 1 year. So that's why the department who do the repair and maintenance, they don't have any income. They just have a cost because they rented out a building, a premises, they have a salary, they have a heating and light, all of these costs they incur, but they don't have any income because they are part of the sales team. So that's why there is some department on the organization, they only incur the cost. For example, the canteen, some of the company, they offer food to the employee. Now, this canteen department, they don't have an income because the staff go for a lunch there or for a coffee, they don't pay anything. So this canteen department only bear the cost. There is no income for that. So if this is the example, we called it cost center. The next center is the profit center. The profit center is responsible for both cost and the revenue. Because if I don't know my cost, I cannot set up the selling price. For example, let's say this pen, if I know the cost is £10, I can select the selling price. I can say the cost is £10. That means the sales price need to be more than that. The sales price need to be more than £10 because if I sell less than £10, I'll make a loss. So if I know the cost, I can set up my selling price and my revenue will be based on that. So the profit center will be based on both cost and the revenue. So they will be responsible for both. For example, if your cost is £10, you cannot sell it for £10 without any profit because you will be responsible if you sell less than the cost. The next center we have the investment center, where the people or the place, they will be accountable for the cost, for the revenue and the investments, all of these three. This is basically the very higher level people who decide where to invest and where not to invest. This is very, very high level people. So they basically decide where to invest and where not to invest. So we would say this is maybe the board of directors and the owner of the business. They decide like, okay, we should invest there, we should not invest there, because as an employee, maybe they don't have any right to say where should invest or where should not invest. So the higher level employee or the directors, they decide of this, and they are the investment center, and they're responsible for cost, revenue, and the investment. The next point we have here, revenue center. So it says person, place, item accountable for revenue. So the revenue center only responsible for the revenue. Let's say it is a sales center, so they only make the sales. So if you tell them like you have to sell this pen 10 pound, so they only will make the sales. They don't have any other responsibility. When there is a performance analysis team will come, they will not ask you any question. They'll ask you, okay, how much you sell. So they want to see the amount, how many product you sell and how much you sold. So your performance, the sales department performance will be depend how much they could sell. So the revenue center, the person and the place accountable for only the revenue. We'll see how it work in the examples. This is a little bit explanation of that. And the final one we have here, ethics, professional ethics. Now, this is the basically, we already learned from the previous paper as well, the fundamental ethical principle. Fundamental ethical principle. So we always do that with a word that you always remember to find the fundamental ethical principle. That is Dr. Pico. Dr. Pico. I hope some of you already remember that, but if you don't, when you go to the ethics question, we'll do it again. All right, so let's move on inside of the chapter and let's have a look what we have. All right, so the first question we have here, that is our activity 1, information for the management. We'll try to do everyone concentrating when you do the activity question, and everyone try to participate, because if you participate, you don't have to do it again. So we'll try to solve the question together. So let's read the first question. Activity 1, information for the management. Says management accountant may provide information for management on which of the following. So they said as a management accountant, he can provide the information to the management which one of the following. Cost of goods and service. So how much is the cost of the good and how much is the cost of the services? Actual cost compared to the expected cost, that is budgeted and the actual, and the expected profit and the production plan. So which one we think as a management accountant we will do? So if you are a management accountant, what will be our responsibilities? From this question, basically, we are learning as a management accountant, what will be our responsibility? What will be our job? Remember, anything that is relevant to the internal management, that will be done by the management accountant. So if we are management accountant, everything will be done by the management accountant that is internal. So here we can see the cost of goods and the service is the internal thing. Actual cost compared with the expected cost, internal thing. And expected profit and the production plan is the internal thing. So we are not preparing the statement of profit and loss account and submit to the outside. We are not reporting to the outside of the organization. So all of this is basically our job. So we can say 1, 2, and 3. All of this is the job of management accountant. All right, so let's move to the next topic. What we have here, it says calculating the cost and the segmented cost. Now let's talk about a little bit what is the segmented cost. Now, sometimes it is important to segment the cost to identify more accurately the unit cost of an individual product. Let's say, for example, let's say we have a two product in an organization. We have a two product. We have a tea and we have a coffee. So we sell both product, and at the year end, we have seen both product give us a profit of 10,000. So as a company, our total profit is 10,000 by selling two product, tea and coffee. Now, this is the aggregation. This is the combination of the two products. So this is the profit 10,000 is the combination of two product, tea and coffee. But the question is, I don't know coffee giving me higher profit or the tea giving me higher profit, because I have sold two product and the total profit of this two product is 10,000. So I have to know which one basically giving me more profit. It's very, very important, because when you open a business, you maybe don't sell only one product. You might sell more than one product, and you have to know exactly which product give you how much profit and which product give you how much cost. Let's say from this tea and coffee, when I segmented the cost, I separate the cost, and I want to see, I'll make the segment of the tea and the coffee to look at which one give me more profit, which one give me less profit. And I end up with my tea giving me 20,000 profit and the coffee giving me 10,000 loss. Rather than giving a profit by selling the coffee making me loss 10,000, and as tea giving me profit of 20 and the coffee giving me loss of 10, and my overall profit is now 10,000. So now I can decide, even selling coffee is a loss business for me. So I can say, if I close the coffee, my profit will be 20,000, because the way I'm operating my business, if I keep doing that, my profit is 10,000, because the coffee making me loss 10. If I stop selling coffee, my profit will be 20, because the loss will be gone, and the tea that gives me profit 20, that will be for the company. So by segmenting your cost, you can decide more accurately which product give you how much cost and how much profit. Now you might think, how come the coffee making me loss and the tea giving you profit? Maybe if you like coffee too much, you can change the example. You can say, okay, I like the coffee too much, so the coffee giving me profit 20, but the tea giving me loss. For me, I think I like tea a little bit more than coffee, so that's why I said tea giving you profit. But it's just example. All right, let's have a look what we have here more. This is the cost card. Let's have a look what is the definition of the cost unit and the cost card. The cost unit here is a unit of product or service which cost can be attached. And the cost card is basically the structure of everything. Is a document which group the cost of the product or service in order to arrive the total cost. So let's say if I said to make a pen, the cost is £10. So this is basically the unit cost, this one. And if I want the breakdown, how come you end up with this £10? What is inside of this £10? So if I break down this £10, so the segmental way the cost will come, that will be the cost card. So let's say the cost card say direct material, direct labor, direct expense, prime cost, production overhead. So this is a breakdown. So if I want to see what is inside of the cost unit, I have to look at the cost card. All right, let's move on. The next point we have how the cost card look like. Let's have a look. How does it look like? The cost card. Few cost is a very important for the unit, for the product or for the services. This is called direct cost. Now, direct material, direct labor, and the direct expense. These three total is called prime cost. In the exam, sometimes they ask you what is the definition of the prime cost? What is the combination of the prime cost? So you have to say the prime cost means only the direct cost. So direct material, direct labor, and the direct expense. If I added these three, that will give me the prime cost. Then after the prime cost, we have two more types of cost. One is production, one is non-production. Now, the production cost is relevant to the specific production. For example, let's say if I want to make this pen, I need heat and lighting. So that's my production cost. So, for example, I need the building. So to set up some machinery, that could be your production cost. But let's say after the production cost, you have to sell this product. So you make the product that is relevant to your production. And to sell the product, you need to spend some cost. For example, selling and admin cost. For example, distribution, the finance, the accountant. All of this cost is not part of the production, but this is non-production cost. So production cost that is basically needed to produce the product, and non-production cost mainly to make the product sellable or sell outside to the customer. So we have production overhead and production cost. So what is the production overhead? Remember, anything that is not direct cost, anything that is indirect cost, we called it overhead. So let's say if I said if I want to make this pen, the plastic I can see on the pen, this is a direct cost. And the light and heating that we used to make the pen, this is indirect cost because I don't see the light and the heating here. So from that point of view, the light and heating is the overhead. And the non-production overhead, we have selling and distribution, admin, finance, and that give us the total cost. So if I add all of these, that will give us the total cost, and we have to make sure we sell the product more than the cost in order to make the profit. All right, so let's move on to the next point. What we have, there is example of the segmented cost. Let's have a look what we have here. Machinery rent is a fixed cost. It is a production cost. Okay, so let's have a look on the segmented cost. We have one example. Try to understand this. If you have any confusion, of course, let me know. I'll try to explain in details. HF Co. manufactured two products, CT1 and CT2. The way we say tea and coffee, they are saying CT1 and CT2, could be anything. It's just example. The profit for the business last year was as follows. Sales revenue for CT1 150, CT2 120. So total sales is 270. Less the cost for material, this for CT1, CT2 both, cost for labor both, overhead both. So total cost is 260. So from 270, if I minus the cost 260, the profit is how much? 10,000. This is the profit from both business. This is the profit from CT1 and CT2 from both product. Now, as a company, of course, you want to see the profit as a whole. You don't want to say like what I sell, I want to split the profit. But it's better to do it. But sometimes if we don't know it, we don't do it because we think both products sell by my company. So I want to see what is the total profit for the company rather than separately. But segment is very important because we need to see which product really bringing us the profit. Now, according to this example, our profit is 10,000 total for this company HF and Co. Now, if we go a little bit down and if we segment the cost, what happened? Let's have a look. So we can see as soon as I segment this, I can see sales revenue for city 1 and city 2, material cost this, labor this and that, overhead this and that, and the total cost for city 1 is 130, total cost for city 2 is 130, but the income for the city 1 is 150, for the city 2 is 120. So we can see city 1 the profit is 20,000, and the city 2 the loss is 10,000. You can see that now. If you don't make the separate, you don't see it. So now you can see selling the city 2 making you no profit instead of making you lost 10,000. So what could be your approach now? Now you can focus on more. How can you reduce more cost for city 2? Because if you spend the same amount of cost for city 2, the city 2 will never give you profit because it making a loss for you. On the other hand, you have to see the sales revenue. Can you increase the sales revenue? Because if you can increase the sales revenue, maybe you can have end up with some profit. So you have to increase the sales price. Now you can take the decision more accurately. But if you don't separate it, you don't know. You're just thinking the company giving a total profit 10,000, so I'm in profit, I'm good. I'll try to making more profit. But if you stop city today, the next year the profit will be 20,000. So this segment cost will help you to take a decision more accurately. All right, so let's move on. Let's have a look what example we have for that. The next point, we have ethical principle. We have some ethical principle. Now, obviously, let me say a little bit about the ethics. Sometimes we always ignore the ethics. We said that's very easy. We know the ethics. So obviously, it's not very important. But to be honest, ethics is the main thing every accountant should have. So you should be always behave ethically. You should not do anything that is unethical to the country, to the people, to the customer, to the employee, to anyone. So you have a set of principles that you cannot compromise. Sometimes people cannot find the difference between the ethical and the illegal. There's two things. One is ethical and one is illegal. Illegal is you breaking the law, and ethical means you are not breaking the law, but you have to always follow certain principles. For example, if you turn off, if you like when you sleep, let's say you keep turn on your heating or lighting on downstairs on the kitchen when no one is there. So basically, if you keep your light on downstairs or on the kitchen or on the garden when no one is there, it is not illegal. Maybe police will not come to you and say, that's illegal, I'll take you to the jail. They'll not do it because it is not illegal, but it is unethical. Let's say when you come from the office, you don't turn off your computer. You said better not to close it because I have to open it again. So you're just wasting some energy. So this is not illegal, but it is unethical. So you have to know the difference between the illegal and unethical. So there is certain principle we cannot breach, we cannot break ethically. So we need to learn what is that. So let's have a look. What is the fundamental principle of ethics? So fundamental means for no reason, for any reason, we cannot sacrifice that. So let's have a look. What is the fundamental principle we have? Luis, you're saying, would that be increased sell price? Well, it depends, Luis. I cannot say you can increase the selling price of the product where there is a making a loss. Maybe you increase the price, but the customer not willing to pay for that. So you have a two option. Either you try to increase the sales price or you want to decrease the cost. Let's say this pen is 10 pound and it's making me loss. And today I set up the price 15 pound. I can set up the price 15, but maybe the customer is not willing to pay 15. So that make me no sell. So that will not bring any benefit for me. All right, so let's have a look. Fundamental principle of the ethics. So we have professional behavior. Professional behavior means you have to behave professionally. So we should comply with relevant law and regulation and should avoid the things that will disrespect or discredit your profession. For example, let's say when you done something wrong that not only damage your personal reputation, it also damage the organization you work for, the professional body you work for. For example, let's say last year there was a scandal for one of the teacher from University of Cambridge. Now, when the news came to the newspaper, they said the person name, also the university name as well. They said the professor from University of Oxford. So they didn't only damage the reputation of this person, also they damage the reputation of the university. So when you will be accountant and if you do something wrong in the news or everywhere, they'll tell there is an accountant, he done some fraud. There is an accountant, he done something wrong. There is an accountant, he done some unethical work. So it will not only damage your name but the profession as well. So when you be an accountant, you have to make sure your behavior is very, very professional. That will never damage your profession. Number two is the integrity. Integrity. Integrity means honesty is the best policy. You have to be always honest. You have to be transparent. When you tell your client, for doing this work, I need 10 hours, you mean 10 hours. So if you need 5 hours to do the work, you don't say 10 hours. So you have to be very integrated because honesty is very important in the business for the long run. So sometimes you see one example could be a very, very good advertising for rest of your life. I can give one real life example that has happened with my colleague. So we give one of the work like to we have a client and this client is quite like he don't worry about the money. This company is really successful company. So he gave a work to one of the juice company in the city, and they said like we need 100 hours to prepare the accounts to the bookkeeping and everything, and we submit the accounts to HMRC and the company house. So we need 100 hours to do it, and there was some efficient employee and they completed within 70 hours, so they didn't use 30 hours at all. And the money they charge, the charge was for 100 pound 100 hours of course, but after that they found they didn't use 100 hours. And after few weeks, the partner of the chartered accountant firm, he called the client and he said, you paid us this amount, but actually we didn't use our expected hour was 100, but our employee they finish it really quick, so we saved 30 hours. So I'm giving the refund for the money that you paid. Now this is one of the example, and the person, the client, he shared this information with a lot of people about this farm, and it become a very, very good way to let the people knows about their integrity. So people knows they're very honest. And he said to his colleague, and we said to our colleagues, and that's how so many people know this farm in a good way. Everyone knows they are very good farm, they're honest. So sometimes you might think the person already paid. What's the point of giving them refund? But maybe one refund can bring you a lot of revenue in future. So integrity is quite important when you be accountant or any business. Then the next example we have professional competence and due care. Now, professional competence and due care means you should have the ability to carry on the work. You should have the resources to carry on the work. For example, let's say today is 28th of January. So let's say 31st January is the deadline to submit the self-assessment tax return. Now, even though the government increased some time, the government said because of the COVID, you can submit your tax return by 28th of February. They increased 1 month, kind of. So now let's say everyone try to submit their tax return by 31st. And let's say you are an accountant and you already have a lot of client and you don't have enough time to do someone work. And few people come to you and said, can you submit my tax return? And you said, I cannot because I'm very busy. I don't have enough stuff to submit, so I cannot do it. And this person said, okay, I'll pay you double. I will pay you more than that I paid to the other people, or I paid to the last year, so I'll pay you more. And because you don't want to lose the money, and you said, I can do it. And you know, if you take the work, you will compromise the work. If you take the client, you will compromise the work because you don't have much time. So you'll do really rush, and there is a chances you will make some mistake. So if you don't have enough resources, or if you don't have enough competence to do the work, for example, let's say you are accountant but not the auditor, and you never done any audit, and one person came said, can you do a internal audit to my company, and I'll pay you this amount of money. And you never done audit before, but you don't want to lose the client, or you don't want to lose the money. You said, okay, I never done it, but I'll do for you. And of course, like, because of that, you don't have enough competence to carry on the work, but still you want to do it. This is not good for you. So you should have the professional competence and the due care to carry on the work. Then the next one, we have the confidentiality. Confidentiality is quite important, very, very important. You don't share, you do not share the confidential information with anyone, even not inside of the accountancy firm. Now, I have seen this question come to the exam sometimes, and they said, are you allowed to share? Are you allowed to share the confidential information within the accountancy practice with the other partner? And some of the students, they think like, if it is inside of the same office and if we work together, then we have to share, otherwise how we will carry on the work? But actually the answer is not. Answer is no, you cannot share. Now you might think, am I going to work alone? The answer is no. So how the accountancy practice work, you have to understand this first. So let's say we have accountancy firm. Let's say this is accountancy firm, and this accountancy firm will not be owned by one person. We call them partner. Call them partner. Every single charter accountant we have, we call them partner. Let's say we have a 20 partner here. 20 partner work for this company, and 20 partner have a 20 space in the business. And this 20 partner have a different client. So one partner do not share information with the other partner. It's not one team they work together. No, under every partner there is a few people work. So you have to understand the way it is work. For example, I'm a chartered accountant. When I go to my firm, I have some employee who just work with my file. So we don't share all this. We have other chartered accountant. We talk, but we don't share about my client. It is possible. Let's say the KPMG is a big chartered accountant firm, of course. So maybe the Tesco is the client of KPMG. And the Sainsbury also the client of KPMG. So do you think the information will be shared to each other? It will be not, because maybe from where the Tesco buy all this thing, the supplier, Sainsbury don't know, and Asda don't know. So if it is shared, so they might know what is the trick, what is the policy they use, and you are not allowed to share the information. So even under the same company, because of the partner will be different, the information has to be confidential. You don't share the information between your partner. You never do that. All right, let's move on to the next point, that is objectivity. Objectivity. A professional accountant should not allow bias or conflict of interest under the influence of other to override professional or business judgment. So you have to be really transparent. You don't give a favor over someone else. So for example, if you treat someone different way and another client you treat different way, you don't do it. So if everyone, any of your client come to you, you should treat equally. Don't be biased. Like for example, sometimes you feel like he's close to you, he's your friend, so you're giving some favor, but other one you don't give favor and you treat them differently. It shouldn't be. So there is some professional guidance you have to follow. This is called ethical act. So you cannot be biased, and you should avoid the conflict of interest. Conflict of interest means you should not do the same work that could be harmful for your client. Let's say you have a let's say um, you have a share of Amazon, and you are also the accountant of Amazon. Now, as an accountant, you know a lot of confidential information. You know that Amazon have a plan to give dividend 10% next year. Maybe you are saying the company situation is really bad, and you see someone other company they are doing good, very good. So you might sell your share from the Amazon and you buy from another company. And maybe if you see you have a client and they are in a business of selling selling the cryptocurrency, and you think I will do that as well. So I'm learning from the client and I'll run my business. So this is basically the conflict of interest. So you should not do something that because of that your client will get affected. So this type of behavior you should not do it. All right, so the way we can remember the fundamental principle, the way you can remember the fundamental principle, we call it Dr. Pico. Dr. Pico. So Dr. Pico will help us to remember what is the fundamental principle of ethics. So P for professional behavior, I for integrity, C for competence and due care, C for confidentiality, and O for objectivity. So if you remember the name of Dr. Pico, you might answer this question very easily. Okay, so what about sharing information within small team working the same client? That should be fine, because if there is a one partner, if you have a practice or if you have an accountancy firm, and if there is only one partner because you work under the same team, there is no problem for that. All right, so Vino, I'm not sure what you mean. I mean the client. Okay, so let's talk about our center. We have a responsibility center, so cost, revenue, and profit. So let's quickly read the definition here. The cost center say the cost center is a location, function, item of equipment in respect of which the cost may be ascertained and related to cost unit for control purpose. So we have a two cost center here, production cost center. These are the factory cost center through which unit of productivity actually flow, and service cost center, this support and service of the production cost center. So let's say when you make a machine, all the cost is from the cost center, and obviously if I say it like I'll give you 1 year after service, so this 1 year is basically also cost center because we don't have an income. The people who make the product, the production center, they don't sell it, so they have only cost. They can say I made this machine and the cost is 10,000 pounds. They don't sell it because sale will be done by the revenue center or the sales department, not by the production department. All right, so let's move on to the next point. Here we have some example. They said, can you find some example? What is a production? What is a cost center? And what is a service center? Let's have a look what we have here. So we have Activity 2, production and service cost center. Classify each of the following cost center as either a production cost center or a service cost center by placing them into the correct column. So basically they give us some pick list and we have to say which one is a production cost center and which one is a service cost center. Now remember, service cost center is only they give the maintenance and after service. They don't make anything. And the production cost center, they make the assemble, they fix it, and they making the packing. They do some type of finishing. So this type of thing is basically the production where the actual work is going on. So let's try this question together. The first one we have the assembly. What do we think? The assembly. Is it production or cost? So we can write P, I will understand, is a production. So that is our production. Very well done, because assemble means you make everything ready to sell it. So let's say we have a few parts, you make it together. It is called assembly. So let's say assemble, A-S-S-E-M-B-L-E, assemble. The next one is canteen. What is canteen? Canteen is a production or service? Canteen is a service department. Very well done, Fatma. Very well done, Belin. Very well done, Michelle. Yes, they are the service because the canteen, they don't have any production. They just do the services. So it's a canteen. Then the next one, we have finishing. So let's say there is a finishing department. What is it? Is it a production or it is a service? Very well done, Vinol. Very well done. Very well done, Kaja. Very well done, Nadia. Yes, this is our production. So finishing. Then we have a maintenance. What is the maintenance? Maintenance is a service cost center. Very well done. Maintenance is service cost center. How about the packing? The packing is a production. Very well done, Elizabeth. Yes, very good, Luis. It's a production. And the last one we have a store. So what is a store? Store is a service. Very good. Stores is a service cost center. All right, very good. So let's move on to the next question we have. Let's find it out. More we practice, we'll learn more. So this is the end of the chapter number 1. Let's move on to chapter number 2. Because this is the first chapter, you can see there is not much thing here, but it's not going to be that easy. More inside we go, we'll see the more depth question, the more technical questions. So we have to learn slowly, a little bit harder. The next point we have here, cost classification and the cost behavior. So the cost classification and the cost behavior. We'll take a break at the 7:30. So from 7:30 till 8 o'clock, we'll take a break. So cost classification and the cost behavior. So how many types of cost we have? We will learn from here. Now the classification, we can categorize. This is my fixed cost, this is my variable cost, this is my step cost, this is my semi-variable cost. We're going to learn all this cost and how they work, how they behave. We're going to learn from this chapter. Let's have a look what we have the chapter overview. On the chapter overview, we can see we have few costs. The first cost is we have the types. The first one we have fixed cost. Now, fixed costs have a two behavior. Number one, fixed costs remain fixed in total. Fixed costs remain fixed in total. That means, for example, if your rent is 10,000, if your rent is 10,000, that means it will be 10,000 for the whole quarter, or maybe for the whole month anyway. If you make any product or if you don't make any product, if you open the building or if you don't open the building, your fixed cost will be 10,000, that is fixed. On the other hand, so this is number one for the fixed cost. So we need to remember fixed cost remain changed, fixed costs remain unchanged. We can write it down here. Fixed cost remain unchanged regardless of activity. So if I make any unit on the production center, or if we don't make any unit, or if I make unit, doesn't matter, the rent will be same. So regardless of the activity, the fixed cost will be same. But on the other hand, fixed cost will be decreasing per unit. Fixed cost will decrease per unit. That means if I make more unit, fixed cost per unit will reducing constantly. So for example, let's say my total fixed cost is 10,000 and I make 10,000 unit. Unit could be anything, could be pen, could be pencil, can be water, any of the production. So when you produce something, the one quantity, we called it unit. In the accounting terms, we called it unit. Maybe it could be like 5 equal 1 unit. Let's say if we said like in one box there is a 10 pen, and if you consider one box is 1 unit, we can say that. If we can say in one box there is a 10 unit, we can say that. Sometimes the company make in a batch, so they want to calculate in a batch, or they can say no, every box there is a 1 unit, so you can say whatever you like. So let's say 10,000 is the fixed cost and we make 10,000 unit. So fixed cost per unit will be 1. To make 1 unit of the product, we have to spend £1 of fixed cost. But just think, this year we make 20,000 unit and the rent is same, that is 10,000 fixed cost. So this time the cost per unit will be, fixed cost per unit will be 50 pence, not £1, because I make more unit this year, and for that reason the fixed cost per unit will be reduced. So fixed costs have a two picture. Number one, it is remain same, doesn't matter of the quantity, doesn't matter of the activity, but fixed costs reduce based on the number of unit produced. If we produce more, then fixed cost per unit will be reduced. If I produce less, fixed cost per unit will be increased. Let's have a look what they're saying here. They are saying total fixed cost constant regardless of the level of output. So regardless of the activity, how many unit we make or not, the fixed cost remain fixed. On the other hand, it says per unit fixed cost decrease with increase in output, the next one. So if the input is increased, if the output is increased, then fixed cost per unit will be decreased. So if I make more unit, if my output goes up, fixed cost per unit goes down. All right, so this is for the fixed cost. The next one we have, that is variable cost. Now the variable cost is changed with the activity level. It's the direct cost, is the variable cost. So let's say the direct material, the direct labor, and the variable overhead. So only the variable cost, normally the direct cost, and this one change based on the activity. If I make an unit, there is a cost. If I don't make, there is no cost. So variable cost will change on the activity level or on the output. So if I make one unit, I will have a cost. If I don't make, there will be no cost. For example, if I want to make this pen, so if I use this plastic, the variable cost, direct material, then there will be cost for the plastic. If I don't make any pen at all, there will be no direct cost for the plastic. So when we spend something for the direct cost, then the variable cost will be increased. If not, the variable cost will be zero. So variable cost will be change depends on the activity level. If you make, there is a variable cost. If you don't make anything, there is no variable cost. Let's have a look what they're saying here. Total variable cost increase as output increase and vice versa. So if we make the unit, the variable cost will increase. If we don't make, there is no variable cost. Per unit variable cost remain constant. This is very important. Cost per unit remain fixed. For example, the variable cost per unit is 5. Variable cost per unit is 5. For example, if I make 10 unit, then it will be 50 pound. If I make 5 unit, then it will be 25 pound. If I make 2 unit, is 10 pound. But per unit, 5 pound is constant or fixed. It's fixed on per unit, but change on the activity level. Semi-variable cost. Now the semi-variable cost is the cost where there is a portion of fixed cost is there and portion of variable cost is also there. So in the semi-variable cost, I can say it is made up of fixed cost plus the variable cost. So I said fixed cost FC plus the variable cost VC. So semi-variable cost made up with fixed cost plus variable cost. So if I said my semi-variable cost is 10,000, so I have to understand inside of the 10,000 there is a portion of fixed cost and there is a portion of variable cost. So semi-variable cost means this is the combination of fixed cost and the variable cost, and we have to split it. In the exam, they will give us one cost. They will tell us the semi-variable cost is 10,000. How much is the variable and how much is the fixed cost there? So the exam will give us one amount of cost, and that will be our responsibility to identify how much is the fixed cost there and how much is the variable cost there. And there is a method to identify that, and that is called high-low method. So we use this high-low method to separate the fixed cost and the variable cost. So we'll see from this chapter how can we split how much is the fixed cost and how much is the variable cost. The next cost we have here, that is step cost. Now step cost is a little bit different than the fixed cost. So a step cost change after a certain level. So up to a certain period, the cost is same, and after that it change up to a next constant level. For example, let's say we have a classroom. We have a classroom, and in this classroom, the capacity of 30 students. So maximum capacity of seating is 30 students. So up to 30 students, the rent for this room is 500. So if I have, for example, 31 student, what will happen? Here, 30 people can sit at the same time. So if I have a 31, Even for one student, I have to rent out another room. So I said I have to rent another room because I cannot make seat more than 30 in this room. So I have to spend even another 500 only for one student. So for 30 student, you can see is 500, and for one student it is 500, because up to this level, up to 30, the cost is constant. It is fixed. Now, for example, if we have only one student for this room, so the cost is really high for us because we rented the whole room only for one student. On the other hand, we have a 30 student here. So that means the cost per student will be really less. For example, if I said 500 is the cost, and if I divide by 30, that will give me cost per student or cost per unit. Here I have to split by only one. So if I divide by one, the cost will be 500 for this one student. So that's how we can see when the unit is more, then step cost per unit will be decrease. But if the unit is less, the cost will be more. So step cost means up to a certain level, the cost will be fixed, and after that, it will be variable. So, for example, uh, let's say, let's say, for example, sometimes like they said, the BT rental, this up to £18. If you have a broadband, £18 is fixed anyway. And maybe after that, they say if you call, then there will be cost. If you don't call, there will be no cost. But it will be fixed up to a certain level, number one, or it could increase a little bit. It depends on the question. If the question said up to this amount, the factory could be used. After this amount, the factory need to rent another room. So you have to spend the whole cost just for one unit. So you need to see should we take it or not. Because for example, if I have a 30 student, I can take this building, I can take this room. But for one student, it's not going to be a very good decision just to hire a whole room. So you might need to wait until few students come so that we can cover the cost. So this is basically the example of step cost. Let's have a look what we have here. Total fixed cost constant up to a certain level of output. Per unit fixed cost decrease with increased output to a certain level of output. So as I said, if I have a number of students 30, then the cost per unit will be less. If I have only one student, the cost will be 500 anyway, but per unit cost will be 500, it will be increased. We'll do some example, we have some exercise, then we'll maybe understand more. But for the time being, we understand we have a four types of cost: fixed cost, variable cost, semi-variable cost, and the step cost. So we need to understand the behavior of this cost and the nature of this cost, and that will help us to identify and to calculate when we calculate the unit cost. So let's move on and let's have a look what we have inside of the chapter. We have some more classification here. We can see cost classification by the function, production, and the non-production. We already discussed that. The non-production cost that is not directly attributable to the product, so that is selling and distribution and the financing. So this department have no relationship with the production. That's why we call them non-production cost. That's why we call them non-production cost. On the other hand, the production cost is the unit cost. So if I want to make this pen, what is the breakdown of the cost that will be identifiable from the production cost? So let's have a look. What is the example here? Saying associated with the production of good and the service. The first one is material. If we want to make anything, any unit, any product, we need the material. And material is always a direct cost. Then the labor. If you want to make something, you need some labor, so it cannot be done automatically. Even if you make something by using the machine, but still you need someone to use the machine. Sometimes some business are labor intensive, some business are machine intensive. The labor intensive means where the company depends on labor, on human work. On the other hand, some business depends on machine work. Let's say, for example, for the production, if we said like printing, printing business. Let's say if you have printing business, you need a lot of printer, so you are depend maybe on the machine. Maybe only two people work for a big factory and there is 100 machine, so we can say this business is depends on the machinery. And some business, for example accountancy practice, you need a lot of human, so you said this business is a labor intensive. Then we have overhead. If any cost that cannot be allocated directly inside of the product, we called it overhead. So overhead could be direct and could be indirect. Direct overhead is directly traced in the product, and the indirect overhead incurred as a result of making a product but not directly traceable. So, overhead, for example, if I said light and heating, how much light and heating I have used here to make this pen, that is not directly traceable. So, I said this is a indirect overhead. The direct overhead, if you spend any cost that you can see in the product, and you can say the portion. For example, let's say if I said like if we want to make ice cream, we have to we have to keep the water in the freezer for half an hour. So this is the fix. 30 minutes we have to keep the water in the fridge, and that will make the ice cream. So you can say for the 30-minute, the electricity cost will be £1. So it is directly recognizable. But if I said how much light I use, I cannot recognize it. Like the maybe for the whole month, the heating and light is only 500, and we make 500 unit. So we just divide it to find how much is the indirect cost per unit. But if you can directly say for this product I need this amount, then of course that will be your direct overhead. All right, so let's move on. Let's have a look what we have else in this chapter. So the next point we have the capital and the revenue expenditure. I'm sure all of you have this idea about the capital and the revenue, because if you've done your level 2, you have already done the classification of revenue and the capital expenditure. Of course, in level 3, some paper also discuss about it. It's very simple. The capital expenditure is basically two things. Either you buy a non-current asset or fixed asset that you buy not for resale. For example, if I buy this pen and I have a plan to use it, not to sell it and make a profit. So rather than I buy it to use it in the business, not to sell and make a profit. So if I buy something not to sell and make a profit, but to use in the business, this is capital expenditure. And this asset, I have a plan, or this asset, we assume we're going to use it more than 1 year. So if you buy a computer, if you buy a van, if you buy a building, we always assume we're going to use this asset more than 1 year. So if you have a plan to use this asset more than 1 year, we called it capital expenditure. The next thing is the improvement. So improvement means you increase the capability of the non-current asset. For example, let's say you have a computer and the RAM is 2 GB. So you have a RAM 2 GB, and what you did, you buy another 4 GB or 2 GB RAM and just install on your computer or fix on your computer, and because of that, the computer is now working more fast. So this is increase the efficiency or capability of the non-current asset. So we can say this is a capital expenditure. But remember, repair and maintenance is never part of the capital expenditure. Repair and maintenance always revenue expenditure. One more thing we have to know: when you buy a non-current asset, if any type of cost you have to spend to buy the non-current asset, for example the delivery cost. Let's say you buy computer, now you have to pay the delivery cost to bring it your home or in your office. So the delivery cost will be also the part of the cost. Let's say you don't know how to set up the computer, you don't know how to fix the Windows, you don't know how to fix the Microsoft. So any cost you spend for that, that will be also part of your capital improvement, because without this, the machine is not ready to use. Let's see, if you buy a building and you have to pay the legal fees to the solicitor for the lease, this cost can be part of the total cost, because without this, the product will not be ready to use, or the asset will be not completed. So this type of cost also can be included on the part of your capital improvement or capital expenditure. On the other hand, we have a revenue expenditure. The revenue expenditure is quite simple. The purchase of goods for resale. So if I buy anything and my plan, I will resell it and make the profit. Number two, maintenance of the existence capacity of the non-current asset to repair and maintenance. This is also revenue expenditure. Expenditure incur conducting the business. So any type of expenditure, for example, you buy a stationery, a petty cash, all of this is our revenue expenditure. So let's see some example, more activity after that. So this is the definition of our classification for revenue and capital expenditure. So we'll take a break now, and when you come back from the break, we will see how many question we have here. I'll try to do all of that. And please, everyone, write your name for the attendance, because this video will be recorded and you will be able to see this recorded lesson from your student portal. So for that reason, it is very, very important you make your attendance, write your name, and that mean team will find you from the attendance record. And in future, you can see this recorded lesson if you need to. So I'll see you in 30 minutes time, 8 o'clock. Welcome back. All right, so let's move on and have a look what else we have here for the classification, chapter number 2. Let's go inside of the chapter and try to do some more exercise. So there is a there is a illustration we can see here. They are saying the difference between the capital and the revenue. Already discussed that the capital is basically the improvement and the extension, and any asset if you buy for use it more than 1 year, and the revenue is less than 1 year. So let's have a look. How can we identify the difference between the capital and the revenue? The first thing, it says extension to the building. So if you make extension of the building, that's the capital. And the next one, we have repair and maintenance. So repair of a building or machine, that's revenue. Legal cost of buying a new factory is the capital, because without spending the legal cost, the completion will not be done. We cannot buy the machine without, or we cannot buy the factory, or we cannot take the lease of the factory without having these legal documents. So that will be the part of the cost. Installation of the new machine, this is also capital expenditure, because if we don't install the machine, that will be not ready to use. Then redecorating the office, that will be the revenue expenditure. So if I redecorate the office, that will be the part of revenue expenditure. All right, so that's very easy. Let's do some exercise. Let's have a look what we have here. So we have the definition of the variable and fixed costs. Let's have a look some chart. How the fixed costs look like. So in the exam, if the question asks you to identify how the fixed cost graphs look like, the fixed cost graph look like this. So basically we have fixed cost that is straight. You see this one is not moving. So this is the caustic structure. Any of the caustic structure we make in a graph, or if you plot in a graph, we have to say how it is work. So on that, you can see in the left corner top, we have a cost. Then we have the output, how many unit we have make, and the fixed cost. So all you need to do, we need to identify if I change the output, is there any impact on the cost? So you can see even if I change the output, the cost remain fixed, is straight. So it's not going up or down. This is the cost point. So fixed costs remain fixed. For example, let's say if I make only unit up to here, let's say 10 unit, my cost is here 100. If I make 20 unit, the cost is 100. If I make 30 unit, the cost is 100. So we can see the fixed cost is a fixed. It's not changing because of the unit or because of the output. This is the main question. All right, Adel, was you asking how about improvement to a building? Example, soundproofing, electrical writing is a capital or revenue. Okay, if you believe you made some improvement, then this is a part of capital expenditure. And if you think it is just a repair and maintenance, then it is not. For example, let's say your home never had any sofa before. So if you buy the sofa first time, so you're making some improvement, that will be the capital expenditure. Now let's say you already have some sofa and you just replace it. So you throw the old one, bringing the new one, or redecorating this one. That will not be the capital expenditure. That will be the revenue expenditure. Now, why it is a matter, like capital or revenue? Why it is a matter? Because both are expense anyway. Why it is matter? If I said revenue or capital, both are expense for me anyway. But there is some regulation for the tax purpose. That's the reason we have to identify this is a revenue or this is a capital. Because when it is asset, this has to be the capital expenditure. And let's say if it is a capital expenditure and if it is an asset, there is some allowance that we can claim on the first year. So if you do your tax paper in near future, you will see there is a two thing we have to calculate. One is called FYA, that is first year allowance. FIA, that is 100%. So up to a certain level, let's say up to 1 million, if you spend for the capital expenditure, you can claim this one as expense. And after every year, you can claim something called WDA, written down allowance, that is 18%. So there is some complexity of the tax calculation. For that reason, we have to separate the revenue expenditure for the profit and loss account and for the capital expenditure for the financial statement. Only this reason, other than we don't have any too much concern why we have to split what is revenue and capital, because HMRC want to see you are not claiming the capital expenditure as expense that is not allowable, and if you claim this one as expense, you are paying the less tax. So if you claim more expense, you have a more expense, that means your profit will be less. If your profit is less, that means your tax will be less. That's the reason HMRC want to see you are claiming the right amount of expense and you're paying the right amount of tax. That's it. All right, let's move on. The next one we have a graphic of fixed cost per unit. We already discussed that the fixed cost have a two phase. The fixed cost have a two behavior. It remain fixed in total, but per unit it decrease. If I make more unit, if the quantity is more, then fixed cost per unit is a decrease. So this is example of that. Let's have a look. The graph of fixed cost per unit. Now you can see that's my output of the unit and the cost per unit. Now you can see if I make, for example, 10 unit, the cost is really high. You see, it's the top. If I make 20 unit, for example, it is touching here, and the cost is really become half kind of here. If I make more unit, let's say 30 unit, then it's become more or less. If I make, let's say 100 unit, it's become more or less. So more unit I'm making, the fixed cost per unit going down, down, and down. So if I make more quantity, then fixed cost per unit will go down. It's very simple and understandable as well. Let's say if we have a one building in one room, so if the cost is, let's say 500 for this house or for this factory per month, and if I make 500 unit, then it will be cost £1 per unit fixed cost. And if I can make 1000 unit, then it will be 50 pence per unit. So more unit I make, the fixed cost per unit will be decreasing. All right, there is activity here. There is example. Let's try this example, activity 1. Fixed cost per unit. Steel Limited makes garden benches and in-car fixed cost of 20,000 per year. So fixed cost is 20,000 per year. So whatever we have explained so far, now we want to check, did we really understand it or not? So that's my fixed cost, 20,000 per year. So there is some example here. It says calculate the fixed cost per garden bench at the following output level. So that means if I make more unit, is that cost going down or not? We are basically checking that. We are confirming that. So let's have a look at the first one, A. If we make 1000 bench and the cost is 20,000, how much will be the cost per bench? So 1000 bench, the first one, and 20,000 is the cost. So cost per bench will be 20. Very well done, Paul. Very well done, Amand. Very well done, Jenov. So this is the cost. Now the next one, let's say number 2. They're saying what happens if we make 10,000 unit? Cost is still 20, but this time I'm making 10,000 benches. So if I can make 10,000 bench, my cost will be more lower per unit. So that will be 2. Very well done, Theodora. Very well done, Vinol. Very good, Fatima. So we can see more I'm making, the cost getting lower. Number C is saying I'm making 20,000 unit. The cost is 20, and if I can make 20,000 unit, so the cost per unit will be how much? Only £1. Very well done. And the final one, they said what happens if we make 100,000 unit? So you can see we can bring down the cost per unit of fixed cost only 20 pence. Very well done, Evelyn. So obviously, more unit you produce, the fixed cost is going more less. So if we try to reduce the fixed cost per unit, we can try to produce more, so that if the output or the volume is increased, then the fixed cost per unit will be decreased. All right, that's very easy and simple question. Any question from here before we move to the next one? That's good. Let's move on to the next one, the variable cost. The variable cost start from the 0. You can see this is the 0 point, and the variable cost start from there. If I make something, there will be a variable cost. If I don't make anything, there will be no variable cost. Listen again. If I make a unit, there will be a variable cost. If I don't make anything, there will be no variable cost. For example, you can see here, if I make 1 unit, let's say the cost is £1. If I make 2 unit, the cost is £2. If I make 3 unit, the cost is £3. If I make 4 unit, the cost is £4. So more I'm making, the cost is increasing. This side is for the cost, this side is for the output. So more I'm making the unit, the cost also going up and up. So this is the definition of variable cost. Variable costs change when the activity level or the output is changed. So if I make a unit, there will be a variable cost. If I don't make any unit, there will be no variable cost. It will be zero. All right, let's move to the next one. So the next one we have here, the step cost. The step cost is, as I said, in the step cost, there is a portion of fixed cost and there is a portion of variable cost. So the fixed cost, that's the step cost, isn't it? That's fixed up to a certain level. So let's say, if you remember the example we said, for 30 students, we need one room. For one student, we need another room. So basically, it's fixed up to a certain level, and after that is increased up to a constant level. It's not per unit, but it's increased up to a certain level. So let's say if I said to look after 20 employee, you need one supervisor. So to look after 20 employee, you need one supervisor. And the cost of this one supervisor, let's say £1,000. So one supervisor cost £1,000, and he can look after up to 20 employee. Now if there is a 22 employee, so for this 2 employee extra, you need another supervisor, and the cost will be again 1,000. So this is basically the step cost. And here you can see it's fixed up to here, then here is increase, then again remains same up to a certain level, then increase, again remains same up to a certain level, increase, again remains same up to a certain level. So up to 20 employee, it remains same. Once it's 20 increase, more than 20 is go up. Again up to 20 is same, is go up after 20. So that's how it is. Go up to a certain level, after that it is going up. So this is called step cost. It's fixed up to a certain level, after that it increase. The next one we have the semi-variable. The semi-variable cost, Kiran. So it is the combination of the fixed cost and the variable cost. We have both inside of this cost. Inside of the semi-variable cost, we have a portion of variable cost and we have a portion of fixed cost. So if the question said semi-variable cost, we have to understand some portion of the cost is variable and some portion of the cost are fixed. And if the question gives us the total figure, we have to identify how much is the variable and how much is the fixed. And we use a method that is called high-low method. High-low method in order to identify how much is the variable and how much is the fixed. Okay, so we'll do some example anyway. Let's move on to the next one. Activity 2. Let's have a look at this activity 2. In this activity 2, we can see they give us some fixed and variable element of cost. Let's read this question. It says an overhead cost. So we have overhead cost that is 580,000. Okay. The total overhead cost is 580, is made up of fixed and variable. So inside of the 580, we have fixed and the variable both. So portion is fixed and portion is variable. The fixed element is 55% of the total cost and the rest is variable. That's very simple, because if we know 55% is the variable, the fixed, then 45% is the variable. So I said, okay, so 580,000, 55% is fixed and 45% is a variable. So let's find it out. 580 times 55%. So the fixed is 319. Thank you, Kiran. Thank you, Olisa. Thank you, Vinal. Everyone have the right answer. Very well done. 319. And the rest is variable. You can do 45%, or you can minus the fixed cost from the total. The remaining will be variable anyway. So you can calculate both way you want. So 261, that's our variable cost. Very well done, James. All right. If you have any question, you can ask me, or you can move to the next question. All right, let's move to one of the very interesting method that is called high-low method. High-low method is a very useful technique, or very magical technique to identify the portion of the fixed cost and the portion of the variable cost. So if you give me the total cost of one unit, or if you give me the total cost of a batch of product cost, so we can identify how much is the fixed there and how much is the variable there. For example, if you tell me the total cost is 10,000, the total cost is 10,000, and how much is the fixed and how much is the variable. If we need to identify that, if we try to find how much is the variable and how much is the fixed there, we will use the high-low method. Now, what is high-low method? As the word said, high-low, high-low. So basically, we look for the higher unit and the higher cost, and the lower unit and the lower cost. So higher unit, higher cost, lower unit, lower cost. And after that, we find the difference. How much is the difference of the unit and how much is the difference of the cost? And if we divide the cost by the unit, that will give us variable cost per unit. And that's how we can calculate the total variable cost, and the remaining will be our fixed cost. So let's have a look. How does it work? It's quite interesting. Let's do that. So we have a unit, output units, and we have a total cost. We'll look for the higher unit. So from here, which one is higher? 32, 37, 48, 53, and 51. So we can see 53 is the higher unit, and the cost we can see 820 is the higher cost. So we'll pick the higher one. First we'll pick the higher one. I'm writing the H. 53,000 unit, and the cost is 820,000. After that, we'll look for the lower one. Which one is the lower unit? So we can see from here 32 looks like is the lower. So we take 32 and the lower cost 505. Normally the unit always give you the lower cost. If the unit is higher, the cost will be higher. If the unit is lower, the cost will be also lower. So 505,000. And after that, we'll find the difference. So 53,000 minus 32,000. How much is the difference? From 53, if we minus the 32,000, that will give us the difference of the units. And the same way, we'll find the difference for the cost. So 53,000 minus 32,000, that will give us 21. So 21,000. Very well done, Evelyn. Very well done, Adel. Yes, it's 21,000. And how about the cost? How much is the difference of the cost? 820,000 minus 550,000, 315,000. So I said 315. So this is step number 1. The first step is done. We find the difference of the unit and found the difference of the cost. The next step is find the cost per unit. So the unit will come down, we'll divide by that, and we'll find the cost of per unit, how much it is. So 315,000 divide by 21,000, and that will give us 15. Thank you, Wong. Thank you, Jeno. Thank you, Theodora. So we have 15 per unit of VC. Remember, this is variable cost per unit. That is variable cost per unit. So if you have 15 variable cost per unit, now you can identify how much is the total cost for this batch. For example, if I know variable cost per unit is 15, so I calculated variable cost per unit of 15. Now let's pick any one. Let's pick this one, lower one, 32,000, and the cost was 505,000. So that was the total cost for 32,000 unit. Now inside of the 505, we know there is a portion of fixed as well. Now if I take away all the variable, whatever is the remaining, that will be the fixed, isn't it? And I know the variable cost is 15 per unit that we have calculated. So I said 32,000 and times 15. How much will be the total variable cost for that? So 32,000 times 15, 480, right? 480,000. Let me write it a bit clearly, 480,000. And if I minus the total variable cost, the remaining will be the fixed cost. So how much is the fixed cost? 25,000. So that my fixed cost. So you can see that we have a total cost. From the total cost, we minus the variable cost, and the remaining is the fixed cost. Now, if you pick any of these, for example, if you pick any one from here, the unit and the cost, it will give you the fixed cost same. So let's say if you want to check, let's try one of the, let's say try this one, 53,000. The total cost for the 53,000 is 820,000, isn't it? Now, if I minus the variable cost, the remaining will be fixed cost. So let's check this one. 53,000 times 15. How much it is? 53,000 times 15. That will give me 795,000. If I minus the 795,000, and it should give me the 25,000 of the fixed cost. So what I mean, anyone you pick, that will give you the fixed cost same. So from this question, we have found 25. Any one we pick, that will give you the 25,000 fixed cost. Now, if the question asks you, how much will be the total cost for 5,000 unit? For example, the question asks you, how much will be the total cost for 5,000 unit? I said, very easy. For the 5,000 unit, the variable cost will be 15. So 5,000 times 15, that will give me 75,000. And I'm going to add the fixed cost 25,000. So the total cost will be 100,000 for 5,000 unit. They could give you any unit. So if they give you any unit, it's not difficult for you, because all you need to do, you need to multiply with that unit with the variable cost, and you add the fixed cost that you have calculated before. So that's how you can do the high-low method, and we can identify how much is the variable cost and how much is the fixed cost. And based on that, if any unit question give us to calculate, we can calculate that. So let's do some practice. Hopefully after that, we will be more clear. So let's do some practice. Let's move on one example. Let's try that, activity 3. Everyone try to participate so that we understand the high-low method very, very clearly. So let's try activity 3. The question is saying S and N recorded the following cost for the last 4 months. So we have a cost, and that's the unit. So the first step, we need to look for the higher one. So which one give you the higher? 8,000 higher. So higher is 8, and the cost is this higher. And the lower is 6,000. Lower is this. And that's how we can identify how much is the cost difference. So I said higher is 8,000 H, 8,000, and the cost is 115,000, and the lower is 6,000, and the cost is 97,000. After that, we find the difference. So here it is 2,000, isn't it? 8 minus 6 is 2,000. And how much is the difference between the cost? So we have 115 minus 97, that is 18,000. 18,000. Very well done, Paul. So after that, what we do, the next step, we bring the unit under the cost. So the 2,000 will go there. So 2,000 is the unit. And that will give us variable cost per unit, isn't it? And how much it is? Variable cost per unit, 18 divided 2, it should be 9 per unit. Very well done. So variable cost per unit, 9. Very good. And after that, all you need to do, we need to find the cost, the fixed cost. Let's pick anyone. Let's pick 8,000. So 8,000, the total cost was 115,000 and 0. So how much is the variable cost for 8,000? 8,000 times 9. That will give us the variable cost. How much it is? Is it 43, the variable cost? 8,000 times 9. So 8,000 times 9, that is gives 72,000. Yeah. So that gives you 72. So total variable cost is 72,000. And if I minus the variable cost, how much is the fixed cost we have? 115 minus 72. And the fixed cost is 43. Very good, Theodora. So 43,000. Very well done, Luis. So that's our fixed cost, 43,000. So we have done the workings. Now any question they ask is not going to be difficult for us. So let's look at this requirement. They said calculate the cost that should be expected in month 5 when the output will be 7,500. They're asking how much will be the total cost for 7,500. Very simple. So we know the variable cost per unit. So 7,500 times 9, that will give you the variable cost per unit. So how much it is? 7,500 times 9, 67,500. Okay. 67,500. And all I need to do, I will add the fixed cost that I have calculated before, 43,000. And that will give me the total cost for 7,500. So 110500. 110500. That's my total cost for 7,500 unit. Very well done, Alicia. Very well done, Luis. All right, so that's how we can do the high-low method. You can see it's a really interesting method. It's quite straightforward and very easy to get the difference and to identify the total cost. All right, so we have a next example, high-low method. Before we move to the next example, anyone have any question from activity 3? Or we can move to activity 4. All right, then let's move on to activity 4. High-low method is quite popular in the exam, so everyone make sure you understand this method. Normally there is a 5 marks exam question will be in the exam, so that will be very helpful for you if you know that very well. All right, can you try that? Activity 4, high-low method, service business. So we have a cost and we have a unit. Let's look for the higher unit. Which one looks higher? So we can see the 3000 looks higher. So we said 3000 unit and the cost is 220 and we have 2500 and that's 200. So we said 3000 unit, the cost is 220 and 2500 unit, the cost is 200. Find the difference. 500, here it is 200, divide by 500, that will give you variable cost. The lowest is 2100. Oh yeah, that's correct. The lowest one we have 2100. That's correct. Very good. So let's do it the 2100. So 2100 as 184, isn't it? So 2100 and 184. So here we have 900. How much is here? 220 minus 184. How much is the difference we have here? That is 36. Very well done. And after that, 900 will go down. And that will give you the variable cost per unit. Variable cost per unit. That is how much? 25 or 0.04. This is 0.04, yeah. Okay. 0.04. That's the variable cost per unit. We have to identify how much is the fixed cost. So let's say 3000 220. So 3000 times 0.04. How much it is? 3000 times 0.04. That will give you 120. And how much is the fixed cost? 100. So now we have the fixed cost and the variable cost per unit. Now we can easily calculate the electricity cost for 2750 unit. So all you have to do is say 25750 times 0.04. That will give us the variable cost. How much it is? 27 times 0.04 is 210. Very well done. And we added the fixed cost with that. That is 100. Is it 310 total? So we have this, or is it? Oh, okay. So we have 110 plus 100. All right. So if I multiply that, 2750 plus 04, that is 110. So 210. That's good. I can see all of you doing one step ahead of me. So I'm behind all of you fast. That's good news because all of you will do the exam, not me. So that will be 210. Well done. That's how we can do our high-low method. And as I said, you will see definitely this question in the exam. But this question will not be like separate in the exam. That will be the mix with other question. But if you do this question, if you know how to get it, you can obviously identify the variable cost per unit and the fixed cost by using this high-low method. Okay, so if anyone have any question, you can ask me now before we move to the next question. No, so let's move on. I think this is the end of the chapter. We'll move to next chapter, chapter number 3. Let's move on and let's have a look what we have on that chapter. We'll try to do 3 chapters in every lesson, but sometimes some chapter could be big. Maybe we'll do 2. If the chapter is small, we try to do 3 chapter in one class. But if the chapter is really big, maybe we'll do 2.5 or 2. All right, the next chapter we have, that is material and inventory valuation. So we'll maybe not do the whole chapter today from chapter number 3. Let's just do as much as we can because still we have 20 minutes to go. Material cost and the inventory valuation. So let's have a look what we have here. The material cost. Now on the material cost, we have some categorize. The first one we have a categorize raw material, work in progress, and the finished good. The raw material. Raw material means the material I need to make the product. Raw material could be depends and different based on your unit, based on the unit requirement. For example, let's say if I am in a business to make the bread, so for me the raw material will be flour. So if I make bread, for me the raw material will be flour. But the person who make the flour, for them the raw material will be the rice or something that need to make the flour. For example, if we are the seller of let's say biscuit, maybe for us the raw material will be flour and eggs or maybe sugar. So for the person who make the sugar, for them the raw material will be sugar cane. So the raw material will be depend what you want to make as a finished good. So if I want to make a finished good as a ice cream, for me the raw material will be the water and the sugar and the milk. So you need to understand the definition of the raw material. So let's see, if I want to make this pen, my raw material will be the plastic. But the person who make the plastic, for him the raw material will be something else. Then the next one is work in progress. That is called WIP, work in progress. So always some of the product under the process. So let's say if we have a process here, let's say we make the bread. So we input the flour here. On the output, as an output, we get bread. So in the machine, we include all this flour. We input the flour, as the output we get the bread. Now let's say this is an ongoing process and we have a lot of machine. So every time and always some of the flour always inside of the machine, and this is not the finished good. So the flour is a raw material and the bread is a finished good. And whatever inside here that is always in process, that is called WIP, work in progress. So you make a value separately for the raw material, you make a separate value for WIP, and you make a separate value for finished good. So that's how we value the inventory. In near future, in chapter number 6 and 7, we're going to see how to value the um, work in progress. But for the time being, you have to understand we have three things. One is raw material, one is WIP, and one is finished good. Then we have a buying material. That's very easy and simple. If you want to buy the material, what is the steps? So first you make the purchase requisition. So purchase requisition is kind of an inquiry you make. Let's say if I said I want to buy some flour. Now, before you order the flour, you will have some inquiry. Let's say you check with Tesco, you check with Asda, you check with Sainsbury's, and you look for the cheaper price with the good quality. And after that, you raise the requisition. And once you're happy with that, you make the order. And as soon as you make the order, then after that you receive the good receive note. Good receive note when the delivery man bring the delivery for you, and you sign there, you said I can confirm I received the product, and that is called good receive note. The next point we have the control of the inventory. How we can control the inventory? So control of the inventory, there is different steps. The first one is called just in time. Sometimes we called it JIT, JIT. This is one of the method used in Japan. In Japan, most of the company they use JIT method because they don't want to keep anything on the warehouse. So they don't want to order a lot of inventory at the same time. So they said we only order when we need. Now, some of the factor is relevant. Before you use JIT, some of the factor is relevant. For them, they think if you keep the raw material long to the warehouse, there is a holding cost. Holding cost means maybe the warehouse you rent it out, there is a cost for that, the insurance cost, and maybe there is a possibility the raw material will be wasted, so the quality will be not be good enough if you keep it long. Now for that reason, Japan, they use the just-in-time methods. Every time they think in Friday I need maybe 100 kilo, so they just order today, so Friday it is come. So they don't keep the stock in the warehouse. Number one. But sometimes even for some countries it will not be possible. Let's say if the product come from a different country. Let's say now the UK, they are planning to order all this dairy from New Zealand. As all of you knows, like after the Brexit, now they have a VAT on the EU, so they have to charge the VAT even the product come from the Europe. And before the UK joined to the European Union, they order all of their dairy from New Zealand. So now they start again the trading from Japan and from New Zealand to bring all the dairy here. Now let's say if they don't stock enough, like any company, if they think they can get it in immediately, maybe sometimes it will not be possible because the distance is really long, and maybe because of the delivery delay your production may be affected. So sometimes it's better to keep something on the warehouse for a minimum stock. So here in the JIT, they do very minimum. They don't keep the stock. But as I said, there is some other factors that need to be considered. For example, if you buy a higher quantity, let's say if you buy a lot at the same time, you have some bulk discount. So if you buy too many unit of raw material from a supplier, maybe a supplier will give you a huge discount because the quantity is really big. On the other hand, let's say if the demand is suddenly go up, you can fulfill the demand. So there is a lot of other reason you order more at the same time because of the delivery cost. If you buy, for example, for you one t-shirt, the delivery cost is £4, and if you buy 100 t-shirt, the delivery cost is still £4. So sometimes when you order a lot, then the delivery cost could be cheaper. So for any, there is a lot of factor. For that reason, some companies maybe they like to order more quantity of raw material at the same time. Then we have locating inventory. So inventory record card. So this one we will discuss later on after we looking at how does it look like. But for the time being, I can say like when you keep the inventory, this is basically the cart you can see, and you can say where is the inventory. For example, if you buy something from Argos, and if you go to the counter, you'll see they will see your order number, and after that they have a mic and they say someone who's sitting in the upstairs, they said some code number, and that person go and quickly find that. So the warehouse is really really big, and if you don't keep with the according to the code or something, it's going to be very difficult and time consuming to find the product. So when you keep the inventory, you keep according to the code so that next time what you need, you can quickly get it, and also how many inventory left, you can see it from the cost card. All right, then we have issuing material. When you issue the material, so basically from the warehouse, when the material come to the production center, there is some steps we need to follow. So you're going to see how we issue the material from the step by step. For example, if you issue the material, you should have a material requisition note. So the production department should say to the warehouse department, I need this quantity of raw material. And after that, then material returned note. If the production department said we don't need that much of material, if they return to you, you need the note as well. And material transfer note, how many material from the warehouse go to the production department, you should record that as well. There is some formula we have to learn from here. There is a three formula. One is called reorder level, one is maximum inventory level, one is minimum inventory level, and there is a EOQ, economic order quantity. So this is one of the formula we're going to learn, and this is the way we can maximize the benefit for the company and minimize the cost. Now the EOQ is 2COD divide CH. This is one of the formula we have to learn. We have to remember that because it will be not given in the exam. 2 is from the formula. CO means cost of ordering. Cost of ordering. D means demand. Demand annually or yearly, whatever you said. And CH means cost of holding. Cost of holding. Now, why we need to know this formula? The reason is, for example, if you become the management accountant, and if your manager asks you, can you order some quantity of raw material that is good for the company so that we can save the holding cost, we can save the ordering cost, and that will be maximize the benefit for the company and minimize the cost. Now, maybe you will be surprised. So you will be like thinking, should I order 10,000 kilo? Should I order 1,000 kilo? Should I order 50,000 kilo? How do I know how many kilo will be very good for the company? So CH is cost of holding, holding cost, cost of holding, CH. So obviously, that time you can tell your manager, all right, I think we can use the Eoq model, because Eoq model will tell me how many quantity I should order. That will be the best, depends on our organization situation. So in this model or in these techniques, it will tell us how much is the holding cost for us, and it depends to company, but obviously we're going to input our data. So we're going to say how much is the holding cost for us, how much is the cost of ordering for us, and how much is the demand for our unit. And if we calculate that, it will tell you, for example, 25,000 unit. That means for you, 25,000 unit will be the best amount to order. That will help you to minimize the holding cost and to minimize the cost of ordering, and also it will fulfilling your demand. So we will do some example. We'll learn with the example in later, but for the time being, you understand the EOQ model will help you to determine how many quantity of raw material you should order. Otherwise, you will be like, I don't know how many quantity I should order. Should I order 10 or 20,000? I have no idea because I don't know how many order will save me more. So this formula will help you to find it out how many quantity you should order. All right. So the next point we have here, that is FIFO, LIFO, and AFCO. Now FIFO means first in, first out. So who came fast, he will go fast. So obviously, sometimes if we if you want to give a real life example, we can say, for example, my grandfather, he came fast in this world, so he will go fast from this world. Then the parents, then me. So it's like who came fast, he will go fast. So first in, first out. In a product categorize, when, for example, let's say if you go to Tesco and you see when the new delivery come, they keep back on the shelf. Let's say there is a biscuits, and let's say there is a new delivery, so they keep the new delivery back off the shelf. The reason is they want to sell the front, whatever you have, they want to sell it fast. Why? Because the front one will be expired very soon, because they buy this one fast. So when you buy something fast, that will be expired fast, so they want to sell it fast. So who came fast, you have to go fast. So first in, first out. So this is one of the method is widely used. If you ask me how many company in this UK they use FIFO, I would say more than 90% company they use FIFO in UK. So first in, first out. Whatever material you buy fast, you have to sell this one fast before you use the recent quantity. So you don't use whatever you order today. You use whatever you already have in the bag. Even like the people who don't know what is FIFO, but normally some people said use that one first because we have this one for a long time. We don't want to open the new box. Open that one is already open. Finish that. It's like kind of a common practice in every business. The next one is a LIFO, that is last in, fast out. This is the opposite of FIFO. So last in, fast out means which one I order now, I will sell this one first, then I'll move to the previous one. This one is kind of rarely used in UK, so it is hardly in some country even they ban the LIFO. They said you cannot use the LIFO. They banned this method, but some company they still use the LIFO. But LIFO is rarely used by the companies, especially where the product expire really soon. The raw material expire really soon. They don't use the LIFO, never. Then the last one we have AFCO. AFCO means the average. AVG. AFCO means the average. So some people said, I'm not going to use the FIFO, I'm not going to use the LIFO to value my inventory. Rather, I will use the AFCO. AFCO means the average. How does it work? So basically, let's say on 1st of January, we have 10 kilo, and each kilo is 1 pound, so 10 pound. On 10th of January, we have another 10 kilo, and the cost is 2 pound each, that is 20 pound. Because more days goes, the purchase price of the raw material goes up normally. Normally anything we buy, the price never go down, is always go up. So let's say now I have 20 kilo of material and the price is total 30 pound. So in the stock I have 20 kilo and the price is total, the cost is total 30. If I use the FIFO, I use this one first, 10 kilo at the rate of 1 pound. If I use LIFO, I use this 10 kilo first at rate 2 pound per kilo. And if I use the AFCO, I don't use 2 or 1. So what I do, I said 30 is the total cost and 20 is the unit. I find the average. How much is the average? So let's say 30 divide 20. That gives you how much? 1.5. So 1.5 per kilo, and I value my inventory 1.5. So this is basically FCO. So FIFO, value with the first unit what you received, you clear that one first. LIFO, the recent one, and FCO, make a total unit and make a total cost, divide whatever the price come. This will be your inventory valuation per unit. All right. So we just explain our chapter overview. Hopefully start the chapter next week. So I hope you have some idea about all of this definition. And the next week we'll start with chapter number 3.